Loud and clear. So it's 2 o'clock London time. Let's start. Welcome everybody to Mercury Partners Academy 2025 Outlook on Markets and Careers. I'm Marcello Zanardo, CEO of Mpa'S and adjunct professor at the University of Padua from this year and at Ca' Foscari in Venice for the last few years. I am delighted. First of all, thank you very much for joining us. We have a very high number of registration, which I'm sure will come over time. And I'm also delighted to have our guest, industry guest, who make these events very special and informative. So we have today Mr. Francesco Castelli, Head of Fixed Income at Banor Capital from London. Francesco will take us through the fixed income markets. Mr. Silvio Olivero, Head of Research at Giotto Cellino SIM from Turin in Italy. And Silvio will take us through the equity markets. Mr. Brunello Rosa, who just came back from Davos with some gossip. I have Brunello. And Brunello is the CEO and Head of Research at Rosa and Rubini Associates. And he will take us through geopolitics, macro, and also digital currencies, since he just published a book on the topic. And as I said, I am Marcello Zanardo. So I'm going to spend just a few minutes before handing over to our guest, just to try to explain what we're doing, why we're doing, who we're doing for, which is basically Mercury Partners Academy. So my background, I'm an industry person as well. I've been working in London in the city for over 25 years as a financial analyst and investment banker. So always looking at markets, mainly European banks, but also other sectors. I help recapitalizing a lot of the Italian banking system as an investment bank. A few years ago, I decided to step into academics. So I was asked to teach at Ca' Foscari University, where I've been teaching financial markets for over 3 years. And recently, Padua University, Professor Francesco Zen asked me to help him on teaching a part of his course. So I will be focusing on financial markets there as well in Padua, starting from this year. My experience in the financial industry over 25 years, together with my shorter, but now started to be significant 5 years experience in the academy, has basically helped me to found something unique, which is called Mercury Partners Academy. What is it? It is a unique London-based educational and employment platform in finance, which is particularly aimed at students and young talent. And what we wanted to achieve, of course, with the help of friends and colleagues and all clients, we want to combine academic knowledge with top industry expertise. Today, you are a flavor of some of our financial ecosystem with the guest. The mission of the Academy is to promote practical and underline practical financial education and help students, talented students, find a job, really, if they like to work in finance in different fields. We try to be innovative, we try to be international, given my history, and hopefully we try to inspire some people as well. In terms of, this is our website. I would just say that you can find the financial education tab, where we're putting most of our free materials on the markets. Then there is the masterclass tab, and then there are the employment section for internship. What do we do at Mpa'S? Mainly 4 things. On top right, as I said, practical financial education is a big pillar. 99% of our activities are free of charge, and every week we post on our social media and on the website a lot of content, and we will go through in details. And then we have a masterclass in investment management, which we implemented together with 8 investment professionals, which is on our website as well. Second things that we do, like today, we do a lot of events and networking with top industry people. We try to bring to students their insights in the markets, in careers, and today's event is an example. The third thing that we do, we give advice talking at universities. We had a talk at London City Universities and Mpa'S Business School the previous year, Ca' Foscari, University of Padua, and many others. So we try really to address students and try to ask their question: what does it take to work as an investment banker, as an equity analyst, and so on. And then internship. We provide internship experience for students. So if I go quickly through each one, in terms of products, I told you practical financial education. Last year, we published 11 Spot the Sector. What we did, we explain in simple terms the 11 equity sectors: financials, utilities, healthcare, and so on. You can find that in our financial education, in short educational videos. Every week, we publish on a Monday Spot the Markets, where I analyze the markets of the previous week in the main asset classes in terms of performance, in terms of news, in terms of macro impact. And then we started doing Spot the Stock. We teach a stock every week, starting from the biggest stock of each equity sector. And I have to say, if you look at the link below, you click on it, it will take you to the website. You will see all of those there. Events. Today's event is an example, but you can see we also host live events. This is the one we did in Venice when I was teaching there. In Padua University, we're going to have this year at the course I'm teaching with Professor Zen. We will have many other industry guests. So online and in-person events are very important. And as I said, to students who are connected and professors who are also connected today, we have an internship program for students, which can join one of our 4 teams. We have a financial AI team. So the students help us produce all the material related to the markets. We have an HR team, human resource team, with students interfacing with universities, investment clubs, student investment clubs. We have a marketing team, and we have a digital marketing editorial team. Of course, as you can see, there is so much work behind what we do, and we need somebody taking care and posting stuff. So first of all, I take this occasion to thank you, all my team who has allowed me to do this event in this form. Benefits and internship. You can see all the details in the website under the employment section. There is an employment tab, but basically the benefits for the student, first of all, is practical experience. A lot of students enter the internship and then they realize that they have the skills to do certain things rather than others. You will have the masterclass on investment management for free, which is our only paying product. Networking, you will be put in touch with portfolio managers. I forgot to mention before, in the room with me, I have also 2 very experienced portfolio manager. Miss Marina Marchand on the left-hand side has been in the market for a very long time from Goldman Sachs and other big houses. So Marina is in the room with me, and she can also answer some question later on careers. And Mr. Stefano Nora on the right-hand side in the room with me, who has been managing money for over 20 years for JP Morgan Asset Management, Pictet, and other houses, is also with me. So as you can see, we try to put in touch the talented students with really experienced people in the industry. Employability, how does it work? If you do an internship with us and you are good, committed, and talented, it will be my pleasure to take your CV and try to place the best talent to the financial ecosystems we have in the academy. So you have a good chance of finding a job. It's not guaranteed, but at least you have a preferential avenue. We have had over 60 interns from 10 different countries. It's interesting to see 65% has been female. The internship is a minimum of 3 months and can be also in a remote form. Of course, we have students from abroad. Not all of the students are in London or in Italy. And as I said, it's 3 months. So the best thing to do is really a lot of students, and then I finish here. A lot of students ask me, how do we do it? The easiest thing to do is to follow us on our social, because there we post all our events, all our internship opportunities. So rather than join my personal LinkedIn, you're welcome to do so, but join the Socials Academy and visit the website, because that's where you will follow everything. After saying this, I hand it over to Mr. Francesco Castelli, who I thank him, and Banor Capital, fixed income specialist. Francesco, over to you.
Thank you very much, Marcello. Thank you very much for having me. Yeah, today we are trying to offer an outlook of fixed income markets a bit better. So in this area, you can see that there was a long-term equilibrium. The long-term equilibrium for fixed income market is that you have positive rates. So people can buy bonds and receive a positive return from bonds. And generally, this return is also in excess of inflation. So interest rates are also real, positive real rates. That was the prevailing equilibrium up until the great financial crisis. And in the last decade, again, with central banks going to negative rates or very low rates, they generated an equilibrium in the market where investment returns from government bonds and corporate bonds, so high quality investments, became very close to zero, in some years negative, and in general below inflation. So investors were willing to lose purchasing power against inflation on a continuous basis. Why was this so? Well, it was the decade of the great financial repression. Banks and insurance companies were forced to buy government bonds for regulatory reasons. Central banks were buying bonds, basically betting on the fact they will lose money, but they will restart inflation and growth. And yes, we were also some private investors and professional investors who were also playing the game. But we knew as investors that we were playing the game of musical chairs, right? We knew that there were capital gains to be done on the back of purchases from central banks, but sooner or later the party would be over. The day the party became over was 2022. So central banks had pushed a lot of money into the system, and this amount of money increased greatly during COVID in 2020 and 2021. And so central banks were pushing more and more money with the idea sooner or later inflation will restart. The big problem with inflation is that you can pump money in the economy, but you don't know when this inflation will come out. A few famous economists, and Brunello can add on this, have talked about the ketchup theory, right? You shake the bottle until ketchup comes out, but generally the amount of ketchup that comes out of the bottle is always too much for what you really need to eat. And in 2022 was exactly the same. The trigger was the military conflict in Ukraine, but the factors behind the explosion in inflation were brewing. There were less people going to work because COVID has put a lot of people at home, paid to stay at home. And there were, of course, a lot of too much money around. And of course, this generated a lot of inflation in the form of energy market shocks. The final result was a sharp increase in monetary policy, as we said, but also a sharp increase in rates. So the rates paid on corporate bonds and the rates paid on government bonds. When rates go up, as you can know from financial maths classes, when rates go up, unfortunately, bond prices go down. And when rates go up very rapidly, bond prices go down very rapidly. And oh boy, in 2002, they went down really, really fast. As you can see, this is the average return you would have made by investing in global bonds. And as you can see in 2022, all types of bonds, from corporate bonds to government bonds to high yield, they all recorded very sharp losses, almost close to 20% in government bonds. This hasn't been something confined to 2022. You can see from the right side of the chart that for government bonds and corporate bonds, these losses are still there. If you are the average government bond investor, still to this day is losing 10% with respect to the prices they had in 2021. with 2021 being the moment when the Federal Reserve started to change his policy from a verbal intervention beginning, but that was the start of the sell-off in the bond market. So it's very important that we consider the historic perspective, and it's very important for the future outlook. And it's very important that we consider that there are a lot of fixed income investors still sitting on massive losses. What we see for the future, then, having discussed the history of the recent history of fixed income markets. Well, first of all, let's talk about outlook for interest rates. Central banks have started to cut rates at the end of last year. We know that the Federal Reserve was very inclined to cut rates very fast, but then we had a few stumbling blocks. The economy in the US is still very strong, so the Federal Reserve probably will not need to cut much. And then the Trump administration probably is going to be a very strong support for the economy. Another reason why the Fed shouldn't cut too much, at least in their own view. Of course, as we heard from Trump yesterday, is not particularly happy with this decision and would like to see rates cut faster. So the market believes, as you can see from the chart, that US rates will decline, but they will not decline maybe as much as Trump wants or as much as we investors want. But they will move down slowly. Europe is in a different situation because Europe already has low rates, but rates in Europe will decline even faster. It is very likely that by the end of the year, rates will be only 2%. In this environment, with rates moving down, the natural reaction from investors should be extending duration, so buying longer and longer bonds, especially because in the last few months, actually, bond prices moved down. Interest rates on bonds went up, so we see it as an opportunity to extend the duration, and we're not afraid to take duration. Of course, when you talk about bonds, we discussed before, bonds like equities, bonds are not a single asset class. It's a very diverse asset class, and you should consider what you want to buy. We think in these circumstances, with interest rates moving down, it's a good opportunity to have government bond assets and maybe some duration assets, so assets relatively long in duration. But what we should do also as practitioners and specialists of different sectors, we also pay attention to single sectors in the interest rate markets. And I'll give you just an example because, as Marcello reminded me, I don't have 3 hours to bore you with fixed income.
3 minutes.
Just 3 minutes left. So that's probably an interesting thing that, but again, is a trade that has been brewing for more than 15 years. So it's interesting to see that how the interplay between interest rates, monetary policy, and fundamentals of the economy can materialize in the corporate bond markets. And one of the other opportunities we see, along with the bonds as an asset class and maybe long duration bond as an asset class, is also the relative value. So the comparison and the trades played on comparison between two different subsectors in the bond asset class. As you can see here, we are comparing lower tier 2 bonds, so bonds issued, subordinated bonds issued by banks, the sector that Marcello is one of the biggest experts in Europe, compared with investment grade corporate bonds. Why we are comparing them with triple B corporate bonds? Because the two lines represent two investments with the same level of rating, so the same expected default rate. The interesting thing is that banks, despite having the same expected default rate and expected default loss as corporate bonds, industrial corporate bonds, so bonds issued by industrial companies, they still pay a premium. So their spread and their yield is much higher than corporate bonds, roughly 1 full point for stable triple B bonds. Why it is so? Well, as you know, a bit more than 15 years ago, we had the great financial crisis. Then we had the sovereign bond crisis here in Europe. And banks have been, unfortunately, the industry suffering the most from these two events. So for the last 15 years, they have been paying a price for the mischiefs of the past. We think the era is over. You can see from equity prices that the banks are now a very much in vogue asset class. And we think this is going to be the year where the gap between the banks and corporate bonds will close also in the fixed income market. And so this is probably, if you want a single sector opportunity, that's what we would suggest for the 2025.
Perfect.
Marcello, I think it's been boring enough. Fixed income is always considered a bit more boring. I try to show the exciting side of it, but yeah, 15 minutes is more than enough.
No, thank you, Francesco. It's been an interesting journey, as you said, really peculiar times before and after. So at least we got this message out, I hope, to students. What we've seen was not normal before. And now we are getting more on a normalized path. That's really the key message, I guess, to say. Okay, you should be able to see Silvio here.
Yes, I see.
Perfect. Silvio,
okay.
Go ahead.
Thank you, Marcello. Thank you for having me here. Good afternoon to everybody. Well, today I'll talk about some key topics in the stock markets, focusing on forecasts for 2025. However, I also take a longer-term perspective because, in my view, and I'm not alone, focusing solely on single-year forecasts is not particularly useful in financial markets. So let's start from long run, not looking to the future, but rather to the past. Having a look at this table that shows the current performances of some of the main stock markets, starting from various initial dates. Each column is labeled with an investment start date, December 2010, December 2011, and so on. Each column displays the performance of markets in descending order, updated as of January 20. Each market is represented by the same color to make underlying trends easily identifiable. There is no, as you can see, there is no investment start date that has not provided investors with positive results across all stock indexes. Performances are generally positive and, in the vast majority of cases, extremely satisfactory. Let me say we have a great future, but behind us. It is also evident that the US market has had a strong dominance over the longer investment periods, while some European markets, especially Italy and Spain, perform better over the shorter periods. It is extremely rare to observe such consistent and positive results, but over the long and short periods, as those you can see in this table. Well, since stocks returns are generally mean reverting, this could mean that a prolonged phase of modest equity returns is ahead of us, especially in the US market, where the performance, as you see, has been extraordinarily strong. But to assess this, we need to examine the market fundamentals. And please, if you go to the next one. Okay, thank you. This graph compares the historical risk premium, the current risk premium for various asset classes. It is possible to estimate the risk premiums of different assets in many ways. In this graph, I used the spread between corporate bonds and risk-free treasury to represent the risk premium for bonds. Well, for stocks, I used the excess cape yield, a measure of equity risk premium introduced by Robert Shiller. In the graph, each bar represents the current risk premium for a specific asset class, while the red dots indicate the historical average. As you can see, all the bonds considered, both Euro and US corporate bonds, whether investment grade or high yield, are offering a risk premium below the historical averages. Similarly, US stocks are priced to deliver a dramatically lower risk premium compared to the historical levels. The graph suggests that investors may not be receiving adequate compensation for the risk they are taking today. And honestly, that's not great news, I think. This is true for many asset classes, as we have seen. However, Japanese stocks are positioned to deliver returns in line with historical averages, while European stocks appear slightly undervalued. The most notable case of undervaluation is in the Chinese stocks. However, we must be assessed with caution, considering the significant geopolitical risk which somewhat reduce the attractiveness of this opportunity. Investors today, in my opinion, must consider such risk and avoid making decisions based only on price. In summary, the year begins with expected returns on risky assets generally inadequate, with only few notable exceptions. On the other hand, the risk-reward offers little comfort for euro-based investors, as the real yield on the 10 years bond is barely above zero. The real yield, not the nominal. The nominal yield is around 2.6%, but with inflation expectation around 2%, we have just 0.5, 0.6% in real yield. This is not true for US because the US 10 years Treasury bond yields in nominal terms of 4.6% with a real yield that is above 2%. But for euro-based investor, it's not true. In summary, to achieve adequate real return, investors cannot remain in risk-free investments. I mean for the euro-based investor. So, Marcello, you can. Okay. Well, next topic has sparked extensive debate in 2024 and will likely remain at the far front of investor interest in 2025 too. I'm talking about the valuation premium of US equities compared to European equities. But before delving into the details, let's clarify what I mean for valuation premium. How do we determine whether a stock, or as in the case, an equity index, trades at a premium relative to another? Well, valuation premiums are typically assessed using multiples such as price to book value or price to earnings. For instance, if stock A has a higher PE multiple than stock B, stock A is said to trade at a premium relative to stock B, while stock B is said to trade at a discount. Premiums and discounts are usually justified by various factors such as growth expectation, market conditions, sectoral conditions. In the example, stock A, for example, could trade at a premium to stock B due to better growth expectations. Well, in this analysis, I estimate the valuation premium or discount between US and European equities using the cyclically adjusted price earnings ratio, the CAPE ratio, introduced by Robert Shiller. CAPE ratio accounts for economic cycles by using a 10-year average of earnings as the denominator rather than earnings for a single year. This adjustment results in a more stable multiple, making it particularly suitable for long-term comparisons. Well, the blue line in the graph represents the percentage difference between the CAPE of US stocks and European stocks. Positive value indicates a valuation premium for US, while negative values indicate a discount. From the graph, we observe that between 1982 and 2011, US equities traded on average at a 12.4% premium to European equities in terms of CAPE. Several factors can justify a valuation premium, and during those 3 decades, there were multiple well-established reasons for paying more for US stocks compared to the European ones. Since 2012, valuation premium of US equities has stabilized at approximately at 40%. And rather than reverting to its historical average, it has risen sharply. 2 significant jumps, one in 2020 and another in 2023, had driven the premium to an extraordinary 86%. So, for decades, market participants deemed a modest 12.4% premium adequate to reflect the US superiority. In recent years, however, investors have shown a growing willingness to pay significantly high premiums for US stocks. Well, what fundamental shifts over the past 15 years can explain this change? Well, we can introduce 2 key drivers. One, a political driver. In Eurozone, sovereign debt crisis in 2010-2011 initiated a political decline that by 2024 culminated in the crisis in France and Germany, the 2 leading nations in the Union. A structural driver. Europe's industrial pillars are mature and declining sectors, such as automotive manufacturing. By contrast, the USA is a contested leader in technology and innovation-driven sectors. Okay, so we found solid reasons for the increasing US stocks valuation premium, but is the current premium sustainable, or did the market overestimate the so-called US exceptionalism? Well, in this scatter plot, I attempt to answer this question, modeling the relationship between the US valuation premium and the growth differential between US and Europe. The data spans from 1982 to 2023, and both variables are adjusted using a 10 years moving average. The relationship between the US valuation premium and the GDP growth differential, estimated through a simple linear regression model, is statistically significant. The current level of US stock premium compared to European stocks would be justified, according to the model, by a GDP growth differential of over 3%. Which seems to me a significant proof of how excessive the current valuation differential is. Assuming a more realistic future GDP growth differential around 1.5% in favor of the US economy, the new equilibrium premium should be around 40%. This is notably lower than the current premium, implying a potential scenario where European equities will outperform. I'm going to conclude the next, just some key takeaways, some for the 2025 and some for the long run. Let's start from 2025. Well, in the US, strong economic growth and confidence in Donald Trump's actions will continue to support the stock market rally, while European equities could benefit from ECB support and exogenous events such as the end of the war in Ukraine. Investors also should continue, we say, favoring risky assets, but with heightened caution and close attention to potential trend reversal. The third key point, the current market rally is driven by the so-called US exceptionalism, making it quite unlikely for European equities to outperform at this stage, despite the extraordinary relative undervaluation we have observed. And now some points for the long run. The first one is a warning. Many assets are positioned to deliver lower risk premiums And lower risk premiums means lower returns, so be careful. And last, it's likely that the normalization of the relative valuation between US and the European equities may take a long time and could accelerate when bear market replace the current bull market. Thank you.
Thank you very much indeed, Silvio. Let me just remind people that obviously we have industry expert managing money online, but the program, this event is mainly for educational purposes. So as you signed, we're not giving any investment recommendation. We're just giving some trends and showing some historical, and the opinion expressed do not lead to any investment recommendation because this is not our purpose. So it's to Mr. Brunello Rosa, CEO and Head of Research, Rosa Rubini Associates. So he's an economist, a macro geopolitical expert, and lately he wrote a book on digital currencies, just published, and he's just back from Davos. Why don't we start from here? You know, all the world leaders met there. You were there. What's new? What's the atmosphere from Davos, Brunello?
Well, it was kind of optimistic, and to some extent this coincided with the fact that there was the Trump inauguration in DC, which sparked lots of energy and animal spirits, starting from the US. But the US, you know, is the largest economy in the world, so whatever happens there has a meaningful impact. There is also a sense that some geopolitical concerns are tamed with a ceasefire in the Middle East and potentially a resolution of the Russia-Ukraine conflict coming sooner than expected, definitely not as soon as Trump mentioned it could. So 24 hours have long gone, but that was in fact impossible. So to some extent, the atmosphere there was vibrant, I would say. And most people were just waiting to see what executive orders would President Trump sign. And you know, he has almost hundreds on his desk, and I think there have been signed in the last few days.
Perfect, thank you. So moving to geopolitics, because obviously we saw how important geopolitics came back on central scene on the last few years. We took peace for granted for many decades, and then all of a sudden bad things happened, as we know. Why don't you take us through this new phase? What is happening? Where are we? And what should we expect?
We have the discussion divided in two parts: Cold War and Hot Wars, which are related. Let's start with the Cold War. We'll come back to this book, I think at the end. So this is a book that an academic from Harvard wrote a few years ago, and he wondered whether the US and China will end up in a hot war, so in a confrontation, in a military confrontation. This is what has happened over the years when an incumbent power has been challenged by a rising power. In 12 out of 16 occasions that he studied, this is what happened. So are these two superpowers going to clash eventually? Well, we don't know. But what we do know is that they've already engaged in what has been called Cold War II. Cold War I was between US and the Soviet Union. Cold War II is the one between US and China. Next slide. So this Cold War II, in our opinion, has three legs: a trade war, a tech war, and the disruption of global supply chains. Now, everybody looks at the trade war, the tariffs that Trump wants to impose. And this is already started in 2018 during his first presidency. And that led, after a tit-for-tat war, to a phase one agreement with China on the 15th of January 2020 that though didn't work particularly well. And so Trump now is fed up with deals. He just wants, go straight to a war with not just China, but all these friends and allies, starting with Mexico and Canada, the neighbors, but also Europe and so on. So, it's true that it's a bit of posturing. He likes to threaten consequences and just to open up the space for negotiation, but still, this is where we are. On the other end, we do have the tech war. The tech war is at the center of, I think, the real Cold War II between US and China. Is way much more relevant than the trade war because its size and consequences are vastly superior. The tech war has 8 components: big data, artificial intelligence, cyber warfare, chip war. A subcomponent, chip war is, if you want, quantum computing, the space race, the RegTech battleground, which is which countries offers the best regulation in technology, and then CBDC, central bank digital currencies, which is what I discussed in my book, and I'll come back to that. But that's the real meat of the Cold War between US and China. Finally, the third leg was the disruption of global supply chains that I can discuss during Q&A. Now, the point of this Cold War is that there is a separation between the two spheres of influence of the two countries, the US and China. US and its allies, especially in Western Europe, Australia, New Zealand, to some extent North America, and China with these allies in Southeast Asia and so on. But once these spheres of influence are established, then you have a number of countries and regions that are up for grabs, so to speak. So they could be battlegrounds for proxy wars. And we believe there are 4 of them. One is Central Europe, the second is the Middle East, the third is Africa, and the fourth is Latin America. And this is where we move from Cold War to hot wars. So let's start from the Central Eastern Europe situation. Well, the first and foremost battleground there is, of course, Russia versus Ukraine. This war was supposed to last a few weeks, and we are already in the 3rd year of the war. On the 22nd of February 2025, it will be 3 years of a bloody war with many people having died and massive financial and real asset distractions. So you see what Russia this is how the situation is at the beginning on the left-hand side, and this is how Russia would like it to end on the right-hand side. You can see that if Russia achieves what they want, so reducing Ukraine to a small fraction of the current territory around the capital, Kiev, this will take several more years of war. How they want to get there, not known. They haven't excluded the use of nuclear weapons. I don't think they will get there anyway. But this means there's still lots of ground there. Still in Central Eastern Europe, we have other open fronts nowadays. In Georgia, there have been contested elections because the president that was elected was considered to be illegitimate because of Russian influence on media and so on. And so there's a kind of a suspension there. Similarly, in Romania, that where the Constitutional Court has annulled the results of the first round of presidential elections, again, for fear of Russian, or proof, call it as you want, of Russian influence. And while all this is happening, also Western Europe start being affected. The German far right, the AfD, has done very well in a number of local elections. You see, for example, in Thuringia, they got almost 33% of the votes, and there are going to be as we know, in mid-February, snap elections in Germany, where the AfD can do very well, and particularly because the new champion of the far right in the world, which is Elon Musk, is pushing very hard for the AfD to succeed. So that's Central Eastern Europe. If you move to the Middle East, there are clearly two main fronts. One is Israel, Gaza, the West Bank, Lebanon. And the second one is the Houthis that are sending rockets to all the ships going through the Red Sea. Now, what connects all these dots? As you can see, there's Iran behind these terrorist groups around the Middle East and various regions, being Hezbollah, being Hamas, being the Houthis. They all start with an H, by the way, it's not by chance. So this is what Iran called the axis of resistance, but there's an open front there, and then the discussion is whether Israel wants to go and have a direct confrontation with Iran in coming months. The third front is Africa. Now, Africa is interesting because, again, there has been a coup epidemic. A number of countries in sub-Saharan Africa have suffered a military coup. They've kicked out the Europeans, in particular the French in the region, and they allowed the Russians to come in. Vice versa, you can read as the Russian came in and the coup happened. Now, Africa might be the poorest continent on the planet, but is also the fastest growing. Its population is meant to rise from 1 billion to 2 billion over the next few years, and China has invested heavily in the region, so you cannot discount what's happening there. Finally, in Latin America, which is considered by the US as their backyard, but in reality is open for confrontation there. China has made tremendous inroads in the continent, and again, also there things are happening. Venezuela has invaded part of the Guyana, rich in oil, and there have been presidential elections that apparently reconfirm Maduro, but there has been, of course, all sorts of discussion on the legitimacy of these elections, and other troubles have been observed in Bolivia and Ecuador. Now, just to finish off, you wanted to return to the issue of digital currencies. Now, these Cold War between US and China is fought, as I said, on many grounds, including the tech war, and among the tech war, the central bank digital currencies. So I wrote an entire book on the geopolitics of CBDCs. The FT was kind enough on naming in among the best economics book in 2024, and thank God we are also a bestseller on Amazon. I'm happy to take any question, Marcello, on this aspect. Just tell me what you want me to discuss.
Cool. No, first of all, thank you, Brunello, because what you've done is you lay down a common thread with all these unfortunate war in the war, meaning that unfortunately there is some sense, because when you shake the existing power of balance of power, then things happen not just where all eyes are, but also in the second deviation, third deviation. So clearly, geopolitics is important because it gives us a sense of why things are happening. At this point, the final message from me will be, and then we open to questions. I think we heard Francesco, Silvio, and you, Brunello. It's all related because the markets react to macro factor, to interest rates, to inflation, to geopolitical events. And the weights of all of these change across time. So there is a period where inflation is core, where interest rates is core, where macro conditions are core. But clearly, you need at least to have, you don't need to be an expert in everything, but you cannot be an expert on everything. But you need to have a general understanding. This is the message to students. Not just to invest in the market, but also perhaps to understand the world a little bit better, because that gives you some more tools to do so. So thank you to our guests. I would just open to Q&A. As I said, It is not just on financial markets, but on career. So feel free, students, professor, anybody, but mainly students, to ask any question you want to know. We have a panel of very experienced people online and in the room as well with me. So any question you want to ask as a student, go ahead.
Thank you very much for the question. Is the question for the day, so it's very, very interesting. I think it's well, the Federal Reserve already had questions. If you remember, back in December during the latest meeting, and Jerome Powell was asked twice, "Would you leave your post if Trump asks you to do it?" And the answer was very sharp and very, I think, one of the strongest answers I've seen in Jerome Powell's career, and said, "Not permitted under the law, full stop." And so 4 words. So I think they are probably playing a game. Trump, also for political reasons, has to push his own cards. I hope, and this is my view, so I hope that Trump will leave, and I think if Trump leaves the Federal Reserve to do his job, it's going to be in the best interest of America. But it's that's my opinion. It's very much possible that Trump prefers to see his own monetary policy. As a fixed income investor, I think the main risk of removing Jerome Powell or bending the Federal Reserve wheels to politics is that you can decide short-term rates, you cannot decide the long-term rates. So my suggestion is, don't look at the short-term rates. Powell, the Federal Reserve, Trump can decide whatever they want. I doubt, without without quantitative easing, I doubt they can control the long end of the curve. So yes, they can bring down short-term rates. They will bring up long-term rates. And as we've seen in 2022, higher long-term rates, higher real rates, that will probably be a problem, if not a disaster, for the market as a whole, so including and especially equity markets. So yeah, if I were President Trump, I would speak as much as I like, but I would leave the Federal Reserve to do his job. But of course, I'm not President Trump, and so I'm sure he has a much stronger political mandate than I do.
Thank you very much. Next question.
No. Geopolitics is not about political risk. Geopolitics is about how countries are and behave in the world, given their circumstances, including natural resources, borders, and so on. It moves much more slowly and much more decisively than political risk. Political leaders change over time. Now, of course, the presence of a political leader compared to another, of course, could make a difference. Given the same set of circumstances, certain political leaders can decide to do something or not. And so the question is, Trump is a man of peace. Trump is a man of war. Trump is an isolationist president. And when you have isolationist presidents, generally conflicts increase. Now, if he had been in the White House the additional 4 years after his mandate, there would have been exactly the same wars that we have witnessed under Biden. Also, he planted the seeds of those wars, for example, by withdrawing the US from the JCPOA, the Joint Comprehensive Plan of Action, that effectively was containing Iran. And we saw what happened in the Middle East after Iran was left out of the negotiating table, and actually with the beginning of the Abraham Accords between Israel and a number of Muslim countries. So he planted the seeds for the wars that we have seen during Biden, not because Biden caused them, but because Trump caused them. Now, people easily forget these things. People easily buy into the narrative of politicians. But now, this second term, we'll see whether he is a man of peace or is a man of war. Clearly, his incendiary rhetoric is not something that leads to peace. The idea that he said he can use force to conquer Panama, to get Greenland, he wants to abolish the border with Canada, that should become the 51st state in the United States, and even called Governor Trudeau instead of Prime Minister Trudeau. Is this a peaceful language? Certainly not. So we'll see whether more wars will come after that. China's invasion of Taiwan has nothing to do with Trump or not. China can patiently wait for Trump to go to do anything else. They will only do it if they think the moment is ripe. But in any case, I don't think it's in their intention to invade Taiwan anytime soon. There's no reason they can get to the same result without going through a full-scale invasion. I'll start given the geopolitical content, and then people potentially wants to add. There's clearly a populist movement on the rise. It was actually way before the pandemic, already in 2015, 2016. Populists were gaining lots of ground internationally. There was Brexit, there was the election of Trump. We had in Europe Le Pen, Five Star, Lega, and you name it, the AfD in Germany, Wilders in the Netherlands, and I can mention many other examples. So the populist movement was on the rise. Then the COVID hit. Now, what COVID did was a return of science in our lives, because populist leaders, including Trump, always dislike science because it injects reasoning and logics in people's mind, while populist leaders always appeal to the guts of people rather than their brains. But this was just a temporary stop. And we see the populist leaders returning to power, and increasingly so. And now we have these, you mentioned corporate, so now we have this sort of weird alliance between populist leader and large corporations that are even financing their ascent. This is what's going on in a number of countries, first and foremost in the US, where you said the tech companies backing the Trump administration and shaping its policies. And of course, when you put together populist ideologies with the trillions of dollars that these corporates have at their disposal, you have kind of a dangerous mix going forward. So, there's something we need to be very, very attentive to in coming years.
I wouldn't say that is just of course, when we talk about Trump policies, a lot of them are labeled as populist and inflationary, which is a possibility, of course. I don't think the primary concern of Trump is discussing with economists on how to model his policies. Certainly, inflation has been a big concern, and the reason why Trump has been elected, probably the key reason why Trump has been elected. So I think Trump would like to have a lower inflation. If I may, I think that the politics and some form of what we label as populist policies might have an impact on inflation. But if I have to make a forecast, I think over the next 20 years, the most important ingredient will be the impact of technology on inflation. So yes, populist policies may have an impact. Any policy, actually, any political decision will have an impact. In the Western world, we have a problem. For the past 20 years already, we've been grown not enough to support social cohesion. And so also zero interest rate policy we were discussing before were part of the reaction of politicians and policymakers to create a growth which is no longer there. The big problem is that policymakers and politicians, the time horizon they have in mind is not long enough to grant long-term growth. So yes, big corporations, they can play evil, they can be a positive player or negative player, but I would look at large corporation and technological sector in particular as the main source of inflation or deflation over the next few years. So I wouldn't focus too much on policy only, but I think the big bet will be how these policies, how these technologies will drive the inflation level over the medium to long term and the growth level of policies over the medium long term. And finally, I don't want to spend too much time, sorry, but I think it's very interesting. When we talk about inflation, in the US, they say, oh, inflation lost the elections to Biden. Yeah, we had a lot of inflation, but the big problem, and people do not realize it, and voters do not realize, the big problem is not inflation. The big problem is distribution of wealth. People were worried about inflation, but the reality that in the US, if you work 2 jobs, and remember in the US, they have only 2 weeks of holidays for 1 year. It's not like us lucky European that we can spend 4 or 5 weeks of holidays. The US, if you work 2 jobs, maybe that's not enough for you to be middle class. So it's not a problem of inflation. The problem is salaries. The problem is earnings. The problem is purchasing power. And so when we think about inflation, let's talk also about how technologies. So we know that we'll reap a reward out of technologies in the future, but how much is going to be inflation, how much is going to be deflation is also an interplay with how well this new wealth will be distributed. And so far, let's say the U.S. economy in particular is not very good in distributing growth and the payoff of tech industries.
So de-dollarization is an ongoing process, and it goes hand in hand with the rise of China, and therefore the rise of an alternative power. So at the moment is still limited. The US still represents 60-70% of the world transactions, and this is unlikely to change anytime soon. But what does China has smartly understood is that they don't need to convince all countries around the world to switch from the dollar to the renminbi. There's no point. The US and its allies will never change that. But what they have understood is that if the world is polarized, then the dollar will remain the dominant currency in the US and its own sphere of influence, and the renminbi will become the currency for China and its spheres of influence. So they will push back the dollar in a much smaller segment of the global economy and not the growing one. How they are doing that? And that's the subject of my book. Not through the traditional system used by the US, which was based on a current account deficit and an open capital account, which allows you to distribute dollars around the world and make them convertible in every currency. That's the dollar nomination recipe, effectively, but through technology. So by building the infrastructure on which new payment system will run in coming years. And once this infrastructure has been built up by the Chinese, other countries, the countries that adopt that, and these are the countries along the Belt and Road Initiative, will not switch to anything else in the future. The US has been very slow in responding to that. Actually, Trump has just signed an executive order that bans CBDC in the US. So the US will lose at least 4 more years in this crucial development. Where the Chinese already have a massive head start because they started in 2014. So they have a 11 years head start plus 4 graciously given by Trump, and now we are 15 years of head start. And then what the US will do will push for crypto and stable coins, which are the market-based approach to digital assets, so to speak. And they will compete with that, but eventually they will realize how crucial CBDCs will be and are to make the digital asset space stable and reliable. But this will happen only after the inevitable crash that you will see in coming years in that space. And it's a welcome crash. People are expecting that. I was in Davos speaking with lots of people in the crypto industry. They are waiting for the crypto winter to wipe out all the excesses, all the scam that is there, and allow only the safe and sound players to remain in place, as is obvious, as is always occurred in the history of financial innovation. And after that, the system will be stronger, more resilient, ready for the future, and they will realize how CBDCs are crucial to increase the reliability of the system. That's what I would say. The alternative to SWIFT is already existing. It's called SIPS, Cross-Border International Payment System, built by China. That is effectively the copycat of SWIFT, but controlled by China. So that is already in place and could be complemented by an alternative system of wholesale transactions, such as wholesale CBDC.
Sure. Maybe I get to answer from this on investment management. Maybe I ask Stefano and Marina, who are with me in the room. They've been managing money professionally. Also, things have changed a lot with new technology. So maybe they can, either Stefano or Marina can give you the answer of today's what are the skills to work in investment management. Then we'll answer the other. Stefano, do you want to come to my You can speak from my computer.
I can speak now. Good afternoon. So in terms of skills in the asset management industry, so the skills, obviously now everything is becoming a bit more data-driven and more scientific and more mathematical based. So certainly some background in mathematics is useful. From my point of view, I still like the idea to have the ability to analyze and to interpret data and put them in context. So I would appreciate even some experience in generally in economics and finance and even in history, which I find always very interesting, just to put things in context. And in terms of work experience, in terms of career, to become a portfolio manager, so especially you start working more as an analyst. First of all, getting to know maybe one specific area, one sector, and then moving to do other things in order to increase and improve your skills and your abilities, and also to be able to specialize in one area and then moving across to do many different sectors in order to understand how companies work from the bottom-up approach, and really to understand all the details that the accounting can, the details of the accounting and the opportunities that this can create in finding interesting valuations and differences between what the real value of the companies is and what the market is pricing. And I think only through kind of a process of developing from, as I said, looking at certain companies and maybe moving to something else, then it will be very helpful then to become a portfolio manager. I don't know, Marina, if you want to add something.
Yeah, I don't know if my camera is working. The only thing that I will say, as a professional certification, I myself has the CFA, which is worldly recognized, and also to be a member, because you've got ongoing education possible certificate is offered. So it's really all your career. You can basically increase your knowledge, and is in all assets, not only in equity, in listed assets. Like I've done, I'm specializing in equities, but also in private assets, which is also very popular now. So I will encourage, I mean, it was paid by my employer, so it's something, I think if you start in any company to try to get your employer a sponsor for this exam, it's a very good for your education. Very good brand name.
Speaking as a both university professor and industry person, I think the best advice I can give to students is to do an internship, either with us or with somebody else, because the internship allow you to do three things. First of all, understand what you're good at. Second, start to learn how to work in a team, which is not really something simple. You think it's simple, you need to speak to each other. And I find that sometimes it could be COVID, it could be new generation. Sometimes people struggle to talk to each other, at least in the way we used to do. And I still think using technology, but talking to each other with words, you can achieve so much more and so much quicker. And the third is really assessing what your true skills are, because I had a few students joining some teams and then learning that actually wasn't really what they wanted to do. So it's great, I think, to invest a little bit more of time to speak with the industry experts, and even before joining university, maybe just to speak with people who have done the course, who are teaching the course. Because if you make the extra effort, you can gain so much in discovering what you're really good at. And the final thing, as a general rule, is don't be influenced what the latest trend is. I want to work in AI, I want to be a data analyst, I want to work, but find out what you're good at, understand what you're good at, and pursue that at any cost. If you want to make shoes, but try to be the best at it. That's my advice. Follow your passion, research it, and go after it 1000%. Maybe we take another 2 questions or so. Okay. If there are no further questions, we end up our event. First of all, I thank you again very much, Francesco Castelli from Banor Capital, Silvio Olivero from Giotto Cellino Sim, Brunello Rosa, who's just left us. I invite students, but also professor and educational staff who attended this conference, if they're interested in being part of this ecosystem for internship, just reach out to us. You can go on our website, write to us on the contact side. If you want to find out our internship, it is on the employment tab in our website. And finally, if you have any questions, just write to us through the contact details on the website. Thank you all very, very much. A special thank you to my team who allow me to do this event in this way, and also a special hello to students of Ca' Foscari and University of Padua, which I'll go very soon. Thank you so much, everybody. All the best.